right, so the Senate passed the Big Beautiful Act. So very interesting, going to the House for reconciliation. But this bill is, I think it's almost 1,000 pages. It might be more now. And then after the House is done with it, I wouldn't be surprised if it's even more. So that's all very fun. And there's no way, we don't have enough time to talk about all 1,000 pages of it, and we're not going to know the full extent of it until it actually passes. But there's a couple things we probably ought to talk about. As CFPs, people who are in the wealth management business, a lot of this stuff is going to affect our clients. So I figure let's get into it.
Yeah, absolutely. And just so kind of people understand the background, obviously 2017 and when the Tax Cut and Jobs Act passed, really that's looking to expire at the end of this year. So this is really looking at extending that. Eugene and I here today, we'll go ahead and just like he said, hit it at the high level, the most important topics. But again, everything's not finalized until it gets through that reconciliation and passes through the House and makes it to the president's kind of desk there. So we'll go ahead and hit the highlights like we said. And Eugene, I'll pass it back to you to start with that first topic.
Absolutely. And an interesting thing, Tyson, is I'm sure you've run into this already, is, especially when you're doing planning for taxes, especially, retirees, if they have an inherited IRA or RMD, Social Security, that kind of thing are coming up. The Tax Cuts and Job Act reduced the marginal brackets. So, if you look at, the second, the third, and basically all those brackets, the 15% tax bracket with that first, Tax Cut and Job Act 1.0, I'll call it, they went from 15% to 12%. The next one went from 25% to 22%. And not to mention, which we'll also dive into, the fact that the standard deduction was increased. I'm sure you have clients where they were itemizing for a long time, which helped with their mortgage. But now the standard deduction is so high, they don't itemize anymore. So those are interesting things, and if that continues, that definitely changes the tax landscape over the next couple of years.
Plus, just keeps the simplicity there, right? Like you pointed out, a lot of people are just using that standard deduction now, which kind of limits the need for increased costs for CPAs and things like that. But as Eugene pointed out, it's a big win for the American people, right? This Tax Cut and Jobs Act is going to save, depending on what tax bracket you fall in, anywhere from 3 to 4% compared to the prior law.
Absolutely. And what's interesting is, in addition to the standard deduction staying higher, I believe it's going to be about $15,000 standard deduction, we also have a senior specific deduction that's currently in the bill. And things change every single day in this thing, right? They're trying to appease everybody. But right now it looks like they're going to pass the senior specific deduction. I think they're looking at like $4,000 right now. So that's going to help seniors even more. The downside to it, of course, if it does pass, is that's a whole lot of revenue not going to the federal government again. So, that's another point where we're going to talk about concerns of deficits, inflation, etc. But so that's definitely something that's going to be advantageous for seniors.
Absolutely. And what does that mean for an individual, right? Like say your annual income's $75,000 and you just use that standard deduction. Your taxable income's only going to be at that $60,000 threshold. So it saves you quite a bit. It could even bring you down a tax bracket. And as to Eugene's comment, for seniors, it's adding an additional $4,000 deduction there. So that's potentially down to $56,000 of taxable income with these changes. Again, also keeps the tax filing very simple for Americans.
Absolutely. And I'm kind of touching back to a point where, doing all these retirement plans and trying to keep everybody in similar tax brackets so they're not punching up and paying a whole lot more to the federal government. The Tax Cut and Job Act undoubtedly simplifies things.
Agreed.
And just the fact that we can at least rely on it for the next few years, it really creates some instances where it's great to start creating taxation, right? CPAs are fantastic because they try to reduce your taxation in the current year. But there's a lot of tax savings that can be had projecting out forward. There's a lot of people who don't realize that when their Social Security, if they have a pension, their RMDs, when those things kick in, let alone deferred compensation, when those things kick in, there's a good chance, if it's significant, you're going up sometimes multiple tax brackets. So if you can kind of even out that income when you're projecting it forward, it can have a huge huge impact on how much money you get to keep.
Agree, and that's what our team specializes in, right? The forward-looking planning, because a lot of people are always backward-looking, more of just filing a return, but a lot of people are looking for, hey, how do I adjust my situation going forward? How do I keep as much money, whether it's in my family's pocket or going towards a cause that I'm passionate about versus the IRS, which is what we're here to do.
Absolutely, absolutely. And something we'll briefly touch on is that SALT deduction cap. Um, Tyson and I are in a low income, zero income tax state. So for us, doesn't affect us. But if you're in one of those high income tax states, which there's one right next to us, right? This could be pretty significant for you. Right now, it sounds like they're probably going to increase that deduction cap from $10,000 to $40,000. So pretty significant. You're going to, of course, details matter. If any of these things are going to pertain to you, or you think they do, make sure you research them. You probably won't get a true, clear answer until after the bill passes and the IRS comes out and says, yes, this is how these things work. I suspect there's going to be a modified adjusted gross income cap on that. So if you're making a lot of money, it's probably not going to benefit you as much or at all. But definitely something interesting, right? That affects retirees. So.
And this was probably one of the biggest complaints in the Tax Cut and Jobs Act when it was passed back in 2017, was the elimination of this SALT deduction, or at least lowering it down to $10,000. And this is really big for the clients in those high tax states, primarily California and New York. So it'll get increased from $10,000 to $40,000, like Eugene mentioned, phasing out at certain income levels. But quite a bit of tax savings, especially if you're in that highest tax bracket. And then I'm reading here, it saves about an average retiree about $4,400 a year who does file for that additional $30,000 SALT tax, which again, the more we can keep in our clients' pockets, the better off they are and the happier they usually are.
Absolutely. And so kind of continuing on with the tax situation, because taxes affect everybody, just about every single person, right? So the estate and gift tax exemption continues.
And this one's huge.
This one is huge, both literally and figuratively is huge, yeah. So it sounds like the exemption is going to be $15 million. And so if you remember, before the Tax Cut and Job Act, I believe it was like $7 million.
Right around there, yeah.
And so now it's $15 million, and I believe it's adjusted for inflation. So they'll probably project it forward as well, where inflation every year increases it a little bit. So this was pretty big for a lot of households, because the issue is the moment you're past that, 15 million, then it was 7 million, all of a sudden you need some pretty complex planning if you want to try to save your dollars.
Yeah, and we were doing a lot of planning around this towards the end of last year and through this year until we started to see this updated version of the tax bill come through. But basically what it means is you really don't have a taxable estate until it's above $15 million. And that's per spouse, so it's $30 million per couple. So really you could avoid a lot of the kind of cost and planning that needs to be done for those larger estates. However, it does not protect you against probate. So there's still proactive planning measures that you want to take to make sure that the assets go to the people that you want them to go to. Of course, avoiding probate, which is a very long and costly process.
Yeah, and so we'll quickly kind of dive into two other topics. One is the no taxes on tips and overtime. That obviously was something that was pretty big on the campaign trail. Not a huge significant change to people who are salary jobs, etc. But of course, if a lot of your income is based on tips, this could be quite significant.
And I really like the no taxes on tips, right? When they started implementing the taxes on tips, especially in our state of Nevada, I was in Las Vegas at the time, so it had a huge impact on the overall economy and just the workers in general. And I think those people that do earn tips, again, they're in an environment where you want to try to keep as much as in their pocket to put it back into the economy versus paying that in taxes. So hopefully this one gets through. Hopefully there's no changes in the House. This is a big one that's extremely popular in the bill, so I would expect it to go through. But again, yeah, just a huge win for the average American worker.
Right. The constituents definitely seem to like it. That's why the politicians are definitely supportive of it. The other interesting one, which I had not heard about until the other day, and that's the auto loan interest deduction. Now it sounds like this is going to be an itemized deduction. So if you are itemizing, it could be very advantageous for you. What I will say with this one is we're going to learn more about it. It sounds like you could possibly deduct up to $10,000 on the interest of those car loans. It sounds like the rumor is there might be a stipulation where it has to be a U.S. made car. So that is interesting, right? Not a tariff, but essentially it's, if you itemize, you're going to be a little bit more likely to probably buy a U.S. made car, which probably good for the economy. But I don't recommend getting car loans with, high interest rates, just to throw that out there, just a financial literacy thing.
And I think it does a couple things, right? It incentivizes U.S. consumers to buy American-made products to help stimulate the economy. But it also helps the foreign automakers, right, really start to consider, hey, should I start bringing some stuff back over to the U.S. as far as the manufacturing, which is, again, good for jobs. We'll see how that plays out, but it's pretty interesting to have that $10,000 interest deduction on car loans.
Absolutely. One thing I'm excited about, this is the HSA, Health Savings Account, changes. So when you get older, one of the big things for you is obviously, paying for drugs and that type of medical care with your HSA is great. But at the end of the day, when you grow older, you want to be living a good life. You want to feel good, be able to get up in the morning, that type of thing. And so the HSA, it sounds like they're going to expand, kind of what you can use it for, which might be gym memberships, permits for Medicare Part A, a lot of kind of cool stuff going on there. And I'm a big fan of the gym memberships. If you can keep people healthier for longer, they'll have a lot better and just more enjoyable retirement. So I'm a big fan of that because I'm also a big fan just in general of the HSA, so I'm all for this one.
Yeah, and I think the HSA is one of the most kind of underestimated investment vehicles that's out there. It's one of the few where you can actually get the triple tax saving benefits, right? The money is not taxed once you make the contribution. It grows tax deferred, and then as long as you use it for medical expenses down the road, it comes out tax free. And there's almost no other investment vehicle where you can get all three tax savings. And what a lot of people don't realize is once you've accumulated a certain balance, usually it's about $1,000 threshold, any monies that you have in account above that $1,000 threshold can be invested into the markets. So I love that they're expanding the services that you can use it for, but I think it really deserves having a conversation around what your kind of overall plan looks like. Because if you can really use this HSA to not only save but accumulate and grow these assets tax deferred, it really sets yourself up nicely for the future when you're in retirement, because medical cost, as we know, is the biggest risk to any one of our clients' plans. So I think the HSA is huge, and if you have access to an HSA and you're not leveraging it, it's something that you should definitely highly consider depending on your overall situation.
And that's a great point. One of the things that we do is, especially for a retiree, right? One of the big things is health expenses, and most people don't realize it, but health expenses, and whether you're talking about long-term care, et cetera, those tend to actually have a higher inflation rate than just CPI.
Agree,
so
yeah.
Most of the time you end up using 5%. So very significant. And the other thing is, when you're working with a client, it's, did your parents have any issue? Do they need long-term care or assisted living? Does dementia run in the family? That type of thing. So very beneficial and definitely something to keep in mind. Talking about Medicaid and the ACA cuts, complicated topic that, not quite sure what that's going to look like yet, so I don't really want to comment too much on it yet. But do want to kind of finish off with kind of the economic and deficit impacts.
Yeah, and if I could just mention one thing on the Medicaid and ACA cuts. From the research that I've done, it seems like they're really trying to cut the expense for those who shouldn't even be on those benefits in the first place. But again, it's a very sticky kind of problem or issue to work out. So again, still a lot of uncertainty around what happens there. We do think there's going to be some changes with this administration, but we'll kind of see how that shakes out. But back to you, Eugene, on that economic deficits, which I know has been in the news quite a bit. And depending on what side you're on, it's either a positive or a negative what this bill's going to do.
Absolutely. And then good point about Medicaid. Yeah, so economic and deficit, it sounds like, whether you're the CBO or you're the retail investor, it sounds like this bill is going to create a lot of inflation. The difficult thing about a bill like this, that like we talked about earlier, is 1,000+ pages. It's too much. But it's a complex economic model, right? You don't know exactly what tariffs are going to do, let alone what the deductions are going to do, and the increase in the standard deduction, etc. So it is difficult to say exactly this much is going to be added to the deficit, or this much is going to do this. But what it looks like, because this is pretty in line with what Congress does normally, is they love to spend money. I have the fear, because to get those last couple of votes in the Senate, it sounds like they very much had to appease these congressmen on a one-on-one basis. I believe the rumor I heard for Alaska, they're trying to get the Alaskan senator to vote on it. And so they were throwing things out like, oh, we're going to increase the deduction for whale hunters. It's like just enough to make it advantageous and make the constituents like it enough to get it passed. It's just, that worries me, especially for a bill this long. But the important thing is you can see it in the market, right? As this bill has kind of made its way through and it's gotten closer and closer to becoming law, you've seen a big spike in fixed income rates across the curve, and one of the things that tells you is people are worried about long-term inflation. And so at some point we'll have a video where we talk a little bit more about that, because that's not a simple model. I know the news loves to put it out as very simple as tariffs are just inflationary and this deficit spending is just inflationary, but there's a lot to it.
I totally agree, and I would say that kind of concludes our conversation around the big beautiful bill. As you Eugene and I had discussed throughout this conversation, there's still a lot of work, I would say, ahead of us to actually get this into law. It's got to go through reconciliation and pass the House, but there is quite a bit of support for it, with a couple outliers on each side. So we'll see how everything shakes out. We'll continue to keep you updated throughout as we get more information. We'll pass that along to kind of the public as well as our clients. And if you have any questions, feel free to reach out.
Awesome. Sounds good. Tyson, I appreciate it. Until
Cheers.
next time.